Hey, what's up, Market Moose? Mike from the Moose on the Loose. I hope you're doing well today. Last week, the Fed and Bank of Canada cut their rates by 25 points. So, what's in it for you? What does it mean for you as an investor and also as a retiree or soon to retire? So, we're going to take a look at that because right now it's kind of like counterintuitive. We have Bank of Canada not with the first cut, actually, it's been several cuts now. And when you look at the TSX this year, it is up 20% year to date. Like, kind of crazy, right? When we expected that tariffs and Trump's going to destroy the Canadian market, well, it's actually doing better than the S&P 500. And to be honest, S&P 500 is not doing that bad either, with being up 13% year to date, including the dividend. So with those double digit growth, why do we have a dividend, like not a dividend cut, an interest rate cuts? So first, on the Fed, well, we have seen that the labor market is softening. There are a lot of chatters, and I kept on like listening to podcasts and read stories about AI helping companies to be more productive, but also helping them to cut some jobs. So, of course, the job market is weakening. We had like plenty of like numbers. They are right, they were wrong. People have changed over there. But long story short, not exactly the most like the strongest economy in the US right now. On the other side, we have a lot of pressure from the Trump administration on the Fed to cut those rates. So probably that was a good thing to wait until inflation rolls out and then see what's going to happen. But over time, I don't know, I have this impression, I've told you before, tariffs will have a lagging impact. It's going to take a while before we get the true impact on the US economy and the rest of the world. But I think that central banks around the world are starting to see that it's probably going to be a big break on the economy overall. So back to Canada now. So Q2 GDP fell 1.6%. Already a good reason to cut down on rates just to try to stimulate the economy a little bit. So it's kind of like, again, when you hear about rate cuts, it's usually not a good news. Like for the long run, of course, for an investor, it means that you're going to get cheaper debt. Companies are going to take cheaper debt. So it may be interesting, but short term, it's probably because they're seeing clouds at the horizon. The GDP falling by almost 2% last quarter is, of course, one of those clouds, but there are more. We have the labor market that is also softening. So unemployment rate is rising across Canada. There are a little bit more risk around that too. We see on the other side that inflation has kind of slowed down. One thing that will help down the line is that the government of Canada decided to take it slow on the tariff retaliation. So instead of like saying, yeah, you know what, you want to make tariffs, we're going to play tariff this both games. I mean, on one side, I can get that it seems to be like you're in a strong position and you want to fight, but on the other, raising tariffs really mean that Canadians, that's your people, are going to pay more for some goods. So probably a good way to not play that game is to ignore the tariffs altogether and try to find ways to grow your economy instead. Don't want to go into politics anyway here. I'm really focusing on the economy and on the stock market. So the Bank of Canada see this as a positive thing for the inflation, but still the labor market is soft, the GDP is down, and there are more concerns coming up. So of course, Bank of Canada, in their latest speech when they announced the cut, they also mentioned that they were worried about what's going to happen with commercial trades across the board. And of course, it will have an impact on Canada. So far, we don't see it that much, but I'm expecting that now that a lot of people have like pre-order stuff to kind of like give them a little bit more room here, maybe a 2-3 months to shift their companies around. Now we're going to see the real problems happening towards this fall. So what does it mean for you as an investor first, and then we're going to talk about as a retiree or soon to retire. So, as an investor, well, of course, when we have those news or expectations, the stock market is actually going up. It's going up short term based on the fact that they're hoping for those rate cuts just because they just look at the companies and they're thinking, well, a lot of companies will be able to borrow money at a cheaper price and then reinvest in their business and grow down the road. So it's kind of like a positive thing that is happening right now. Imagine that you have to borrow a few $1,000,000. Well, you're happier today than you were 2 weeks ago when the interest rates were a bit higher. So that is one thing. However, it also tells you that probably the economy is not doing that great. And if the economy is not doing that great, well, following up on earnings in the next quarters are probably going to be tougher. We may see disappointment. We may see revenue and earnings slowing down. So here's the thing. I'm telling you this, and you probably hear, oh, wait on the sideline. It's going to be a great opportunity to buy the dip, or there's going to be like a correction or something. That's not what I'm saying. As an investor, I will not change a thing. And I'm going to tell you why. Do you remember a long time ago, like literally 2 years, so many people on social media, we had like articles across the boards also on financial websites and newspaper about Canadian banks and their variable mortgage rates, where a lot of consumers were now seeing their amortization growing as they make payments because the payment was not enough to cover the interest. And everybody back then, they were screaming, oh, they're going to eat it so badly when they're going to come up with the renewals in 25 and 26. So 5 years after COVID, where the rates were super low, and all of those people, they're going to lose their house and yada, yada. And then fast forward to today, I don't know, like, have you seen any problems with the latest quarterly earnings from banks? I mean, they're rolling. They're making so much money right now. Profit is up. Revenue is up. Yes, provision for credit losses, it's a little bit hot as well. But still, no one here in this industry is taking a huge hit and having a problem with their loan portfolio, and there's no mortgage crisis whatsoever. So when you anticipate a crisis, well, this is what's happening, right? You're looking at your crystal balls, you're making your best bet, but your guess is as good as mine. So instead, why don't you have a very solid investment strategy and stick to it? This is what I do, and I'm not going to change a thing as an investor. Now, yes, as a retiree or soon to retire, you're a little bit more concerned about your portfolio and the clouds of having a market crash or a correction, to say the least. And we're a long time due for that, but maybe it's going to happen only in 3 years. So what can you do right now as a retiree? Well, what you can do is that you first clean your portfolio. By cleaning your portfolio, I mean making sure that everything is in order, that you have high quality company, that you know what is your strategy, and you know that your portfolio is aligned with that strategy. Because sometimes when the market goes up, we tend to forget we're taking bets, we're making money, we're happy. Now it's time to review all of this, making sure that everything is under control and you know what you own and why you own it. The other thing as well is income is not going to protect you. A lot of investors are telling me, yeah, well, I do like 10% or 15%, like those crazy high yield. So I have like plenty of income, and if the market crashes, I'm just going to rely on that income and I don't need anything else. Well, that's not entirely true, because most of those products, and this is come back to know what you own and why you own it, most of those products are risky. And when the market goes down, they're not able to sustain their distribution. So therefore, that juicy 10, 15% or whatever is not going to remain. It's going to get caught. And if it's getting cut, well, then you're affected by that market crash, because your portfolio value is going to be down, but your income is also going to be down. So you want to make sure that you clean and revise your portfolio for that. And actually, a good solution would be to have like a cash reserve on the side, and that will protect you from any crash, because then you have that flexibility of just getting the money from the cash reserve instead of your portfolio. If you want to know more about information about income focused product for retiree, I do have a complete guide reviewing 20 different income product. You can get it for free at retirementloop.ca/income. Retirement Loop, .ca/income. You're going to get the guide, and you're going to get more information about your retirement that is for 100% for Canadians. So I think you're going to like this newsletter. All right, Moose, that's enough for today. Tomorrow, we are going to review dividend growth investing. Is it still relevant for investors, for people that are about to retire? What's going on with that strategy? Should I continue or should I not? So take good care today. And until then, don't forget to stay invested.